All right. Welcome, everybody. This is a You've Got Options segment for Income Navigator. Today is Thursday, February 29th. And today we are going to be talking about a pretty interesting topic. This is something that came up in our Discord a couple of days ago. We went back and forth, created a thread. There was a pretty interesting exchange. And the topic was um, possibly converting a put debit spread with very little time until expiration into something that would resemble a Black Swan hedge, which I think is very interesting because this comes up from time to time, and people do look for ways to put on some sort of Black Swan hedges. And I think this is a very neat way to possibly turn your leftover position into something that will not only protect your some of the newer positions in the series of 112 or 11X bear traps you may be holding, and it doesn't really cost you a whole lot to do so. So for today, we are going to look at a possible way to turn a leftover put debit spread into a Black Swan hedge. We're going to dive in and look at the Greeks. For those that are not familiar with the Greeks, please do not feel alarmed or don't feel that this is way way over your head. You will get there in time, but I want to stress that Greeks are important, extremely important, if you want to make adjustments and potentially improve your positions over time. And we are going to look at few different scenarios or few different adjustments that could potentially fit your trading plan, or I said inventory. These are positions that you may be holding within your trading framework. So this is a trade, and I'm going to go back and kind of just to recap where we started to show you, where we are today. This is a 112 bear trap that started in December, on December 12th of last year. As you can see, DTE was 94 days until expiration. The underlying was XSP, which is the S&P 500 index options, just a smaller contract, not SPX, but XSP. And the setup for this trade was this was a 7-point wide put debit spread, fully paid for by a sale of 2 times as many short puts at 390 strike. Right, so I sold 20 390 puts, and I bought 10 of the 7-point wide put debit spread, which was at 455 448. And the trade set up as such. We had a tail profit, which is here. This was a $510 tail profit. Inside the trap, we had 7 points, which is $700 per one spread. We had 10 of these, so that's $7,000 profit in the trap, plus the tail profit, which put us at a total of $7,510 in the tail. I'm sorry, in the trap. So the tail was 510, the trap was $7,510. The Greeks to start this trade were delta was plus 14, gamma was negative minus 1.28, with positive theta plus almost 50, and vega was negative. The other day in our private small group session, I said something along the lines of, if you want to think about relationship between theta and vega, they're always the opposite. If you have positive theta, vega is always going to be negative. Now, I know we can go into the weeds here and talk about, calendar spreads and diagonal spreads where theta and vega are on the same team or moving in the same direction, but it doesn't really work that way. This is a pretty good example of if you're putting on trades that are positive theta, you're always going to be net short premium, right? So this is where this trade started from. This was 94 DTE. And then we're going to go forward. This is 73 days later, right? So the underlying has moved quite a bit to the upside from December. Anybody that's in the market knows. We have 21 days left until expiration. The underlying is trading at 509.53 at the time with 21 days to go. And the date of this screenshot is Feb 23rd, which is about a week ago. So at this point in time, the naked puts that I sold at 390, they've lost 91% of their value, and they could be closed for 8 cents. And I had 20 of these puts. So I was going to buy to close the 390 puts for 8 cents each, 20 contracts. The cost of this adjustment was $160, right? So that's a debit. It's a negative transaction, or this is a debit transaction, which means that this $160 debit is going to take away from our initial credit, which was 510. And here I made a note that the tail profit goes from 510 to 350. So if you back out 160 from 510, you get 350. So now closing out these naked puts will reduce my tail from 510 to 350. And the same thing in the trap, right? And at this point in time, we can see that my Greeks are now, with the price so far away from the trap, I have barely any delta, which is good, right? We don't have any directional exposure to the markets at this point in time. With 21 days to go, market could go up, market could go down. This position is very delta neutral and non-responsive to any price changes day to day until we, move quite a bit to the downside. And if we continue to move to the upside, we're going to lose more delta. And you can see that delta will decrease over price and over time, right? And eventually, if the price continues to move higher, the delta will pretty much disappear, and this position is going to be really delta neutral, right? Gamma is also here insignificant. We're still presumably making about $25 a day due to decay of these options. And our Vega has also decreased quite a bit, right? When we started, the Vega here was minus 358, which means that we were to lose about $360 for every 1 point that volatility was to go up. And now, 73 days later, we don't have much exposure to volatility as our Vega has decayed due to the time passage as well as the price. So this is what this 112 looks like after I bought to close those 20 of the naked puts. This left me with a put debit spread. This is the 455, 448. My tail profit is 350. At this point, with 15 days to go, right? If the price continues to go higher, the most I can possibly make here is the remaining credit, or $350 for this 10 lot. If the price was to go down, right, and down quite a bit, we can see that, we're talking about in excess of 11, maybe 12% in 15 days. The max potential value of this put debit spread is 7 points, or $700 per one spread. And I have 10 of these. So that's $7,000 plus the 350. So the max potential reward for this put debit spread is $7,350. And you can see that the Greeks here, since I closed those naked puts, my delta went from pretty neutral, right? I was plus 3.57 delta, and now I am minus 3.55. So it doesn't really change a whole lot, right? Plus 3, minus 3. It's still not very responsive to day-to-day changes in the price of the underlying asset. My gamma flipped from negative to positive, but it's also so small that it doesn't really make much difference. My theta went from positive plus 25 to minus 3.6. Doesn't mean that I'm losing a whole lot of money here, but you can see that at this point, with 15 days to go, my unrealized P&L is 375, and if I hold it for 15 more days, this 375 is going to turn into 350, right? So I am going to lose um, the remaining potential profit here, and this potential profit is the value of this 7-point wide put debit spread, right? At expiration, this put debit spread is going to be worth nothing. At this point in time, with 15 days to go, this put debit spread is worth the difference between 375 and 350, or $25 for the 10 contracts. It's worth literally $2.50. So, and Vega also closing out those naked puts, my Vega went from negative 17 to positive plus 7. So, in other words, I'm actually going to benefit if implied volatility is going to increase, right? If volatility is going to increase, and the potential or implied range, which, at this point at 15 DTE, maybe the range is between 490 and 530. But if volatility is going to increase and the range is going to go from 490 to maybe 460, and from 530 to 550 or 560, right, the value of this put debit spread is going to increase. So that's nice, right? And also this leftover put debit spread is going to offset some of the buying power requirement for any of the 112 bear traps that I may be putting on with more days until expiration. Why? Because if the newer 112 bear traps are going to get into trouble with the price going down, this leftover put debit spread is going to offset these losses. So the broker doesn't view your risk as great as long as this put debit spread is on, right? So these leftover put debit spreads are a great way to possibly reduce your buying power and also leave something on just in case the market decides to do something really stupid and go down like 11 or 15% or more to the downside. It's not going to completely save your newer 112s, but it's definitely going to help you offset some of the losses you may be taking on with some of the newer trades. And that's why it makes sense to close out the naked short puts when they lose enough value and leave the remaining put debit spread to protect some of your newer positions. And the cost of putting this protection on, remember, we went from tail 510 to now tail 350. So the cost is $160. So now we can look at, with 15 days to go, we can look at turning this put debit spread into something that will look like a Black Swan hedge. And one way to do it, and this is the discussion that we were involved in last couple of days, just looking at different scenarios. So scenario number one was just removing the short put of the put debit spread. Remember, this put debit spread is 455, 448. Okay. And removing the 448 will leave me with just 10 long 455 puts. These 448 puts are going for about 15 cents each. So I have 10 of these puts. My total cost would be $150, which will reduce my tail profit from 350, right? I'm going to spend $150. So now my new tail profit here is $200. Okay. And the tail profit is reduced by the cost of this adjustment. So this is my new potential reward if the price just stays where it is. And you can see that um, right now, or with 15 DTE, I have an unrealized gain in the straight 370. If I do nothing else, or if I just close the 448 and nothing else to it, eventually, due to theta, I'm going to reduce my potential reward into realized gain of only $200. But if the market is going to do something crazy and go down like 10, 15, 20%, you can see that my T plus zero line, this is the green line here, right, is really going to pick up on the way down. So that's one way to make an adjustment that will not only protect you down to about 455 level, but beyond that, right? Just to close out the 448 and keep the 455 puts. And you can see that in the Greeks here, if I was to close the 448 puts and just keep the 455 puts, my delta goes to minus or negative 18. So I'm short delta. I'm actually looking for the market to go down because I will make about $18.44 for every 1 point that the market goes down from this point on. Right. And this number is going to change day to day. So don't, assume that you're going to make $18.44 for every 1 point. You can see that, if we were to go from 506 down to 500, now my delta is 33. And this is because I have positive gamma. And as we go down, right, the gamma is going to add more and more negative delta. And at some point, right, let's say at 470, my delta goes to negative 400. And right now it's negative, let's call this 20. Right. So we want the market to sell off. We may not want to have the market sell off because some of the newer positions are going to be in hot water. But in case if that happens, this remaining long put is going to really help out. So that's the idea. Right. So that was the first example, or scenario number one, just removing the short leg of the put debit spread. One of our members proposed something a little bit different. Instead of removing the 448, this member suggested spending the same amount of dollars to buy a put a little bit further away from the put debit spread. And with 15 days to go, and these puts being so far out of the money, they're all are pretty similarly priced. So I looked at this today, and the 445 put is also trading at a mid price of 15 cents, right? So the cost would be similar, $150. We back out 150 from 350 tail profit. That leaves us with max potential profit in the tail here at $200. And the tail profit is reduced by the cost of this adjustment. Same exact thing as the previous adjustment. Except the difference is you could probably see this a little bit better here, right? We have let me erase all these things. So now you can see that we have this remaining long put. If we were to, instead of closing the 448 puts, and we were to buy puts at 445, which are just 3 points further out of the money, right? We kind of just shift this long put payoff graph a little bit further out of the money. But if you compare the two risk graphs, they're both very similar, right? This is graph number one. This is just closing the short puts. And then this is what it would look like if we were to, instead of closing the 448, if we were just to buy the 445. So in this scenario here, we would be left with a 455, 448 put debit spread and the 445 long puts. But if we just compare the two risk graphs or just look at the Greeks, right? So this is just closing out the short leg and leaving the long puts, right? We have a delta of minus 18. And if we look at a different adjustment, which is to buy to open, puts slightly further out of the money, we have a little bit less negative delta, right? Which means that this proposed scenario is going to be slightly less responsive to a move lower in the underlying price. Gamma here goes from 1.71 to 1.55, which means that for every 1 point that we move lower, our delta is going to change at a lower rate, which is also not great, right? Because we really want our deltas, if the market's going to start moving lower, we want our deltas to accumulate as fast as possible because that's what's going to get us to a higher P&L number. We can look at our theta, and I think the only thing that the proposed adjustment has in its favor is the slower rate of decay of options, right? So here we have a theta of 38. This is buying one or buying long puts further out of the money. Theta is minus 38, which means we lose about $38 per day versus 39 or 40 with just closing out the short leg of the put debit spread. And then one important part I think here is the Vega component, right? So in this example here, we have a Vega of 46, which means we are going to make about $46 for every 1 point that volatility is going to increase. And we have to assume that if the market starts to move, 20, maybe 30 points on the S&P on a day-to-day basis, Vega is not going to do much. Like, we need to move outside of one standard deviation couple of days in a row for Vega to really to wake up and start to reprice some of these farther out of the money puts. But we can see that in this proposed scenario, we have Vega of positive 46. So that's plus 46. And in this scenario, Vega is plus 43. Not a big difference, but again, lower negative delta, lower positive gamma, and lower positive Vega make me think that buying puts to open on top of this put debit spread, this position is going to be a little bit less responsive than just closing out the short leg of the original put debit spread and leaving the remaining long puts to either expire or really kick in the event that the market does go down in excess of 10% or so. I'm going to just go and look at some of the questions here. How often does the market go down 12% in 2 weeks? Not often, but it does happen. If you were around in 2022, I think, we had several times when the market went down 15% in a week, maybe a little bit more. In 1 and 2 weeks, market did go down 15%, then rally up 15% in a week. So things do get crazy when we are in the bear market. We are not seeing that right now because we are in a pretty sustained uptrend. Good question from Tom. Do you have a sense of how much time remaining makes it worthwhile to do this? I do this almost on every single trade. Just, so if you're going to spend, you know, in relative terms, I guess it's quite a bit. If you're going to spend 150 of $350, yes, you are potentially, taking a big chunk of your potential earnings to to keep this um, Black Swan hedge, if you will. But if you have a pretty good campaign going and you're constantly putting on new positions, I think the cost of having a protection for the next 15 days or maybe for the next 21 days, I think it's worth it because we never know when Black Swan is going to take place, right? There are no warning signs. There's no Jim Cramer telling us that, look out for it. Just happens out of the blue. Like think about, and everybody wants to talk about Black Swan hedges, and you got to think about the COVID crash, right? Sure, the market was kind of weak, and there were headlines, and but the market, before you know it, the market was down 15%, then it was down 20, then it was down 30. Things get really, really crazy when the market starts to sell off and volatility starts to pick up. So with 15 days, you may look and say, why would I want to hold this for the next 15 days? It's very unlikely, and you are right. Right? If you look at the delta of these 455s, there may be a delta 2. What does that mean? That 98% of the time, these 455s are going to go out worthless. But it only takes one time when, the market goes down 20% in 4 days, right? You get a couple of limit downs back to back. You're going to wish you had something like this on. So I think it's just, a very inexpensive way to kind of give your newer positions a little room. Again, this isn't going to save you from taking a loss potentially in your newer positions, but it's definitely going to offset some of the losses and maybe buy you time to figure out what to do with positions that are really taking on heat. Another question. Typically, we have a circuit breaker at 7%. What if you just took the hit and closed everything then? I think this is a really good question, right? We have a circuit breaker, which is great, right? If the market goes down 7%, we'll take a 15-minute break, go get a coffee, and think about what you're going to do next. But the problem is that when the circuit breaker goes away and the markets are open, I could almost guarantee that the bid and the ask spread is going to be so wide because the market makers also have to figure out what the fair price is, right? You have all this demand for options. They don't know what the fair price is, so they're going to jack up IV and ask way more than what you're willing to pay for that protection. So if you're scrambling, right, after the circuit breaker goes away, odds are, you're being pushed in a really um, position that's not to your advantage, and you may end up paying way more than you should, or way more than you would pay if the market was not selling off to the tune of 7 or more percent. So liquidity may be an issue, and while you're trying to figure out what the fair price is alongside with the market makers, this leftover Black Swan hedge is going to kind of help you a little bit, because again, what we're looking at right now, we're looking at a risk graph, and this is not accounting for any volatility adjustments. If volatility is really going to spike, and I could assure you that volatility with 15 DTE is going to be way higher than if you look at the option chain with 90 DTE, I think this T plus zero line is going to be way, way higher. The problem is that, if you wanted to maybe close out this hedge, you may be dealing with potential liquidity issues, because again, bid ask spread is going to widen out, and that's the liquidity risk is definitely there. Um, Another question: have you considered the commission and fees in Tasty Trade closing is much cheaper than opening? This would speak against you buying. Yeah, I get. I mean, if commission and fees is what's going to make or break your trade, it's probably not worth doing the trade to begin with. But sure, commissions, you can consider that as, if as we go through these different ideas and you consider different factors, yeah, sure, commission and fees, um, is a major factor that you definitely want to consider. And if your commissions to open is, way higher than to close, then maybe it is simple. Given the fact that, we just looked at two different scenarios, and we kind of understand that just closing out the long or the short leg of the put debit spread, leaving the longs, is a better way to do it. Considering the fees and commissions, that makes the case for closing out the short leg even stronger. JP saying buying power reduction is probably better on closing the 448 instead of buying the 445. Maybe not. I think that buying 445 will, um, it may offset buying power a little bit more, but that's going to go away pretty fast. I don't think it's a significant difference. I mean, I could be wrong, but and we can look at it and try to figure it out. But I don't think that the buying power difference or buying power relief is going to be significant enough for me to rule in the favor of one or the other. Another question: at what point will you pull the naked puts from the put debit spread? I don't know if there is a specific window, right? We're looking at here, this is 15 days remaining in the trade. I guess the answer to that question would be whenever you can buy back the short options of the put debit spread for as little as possible, where it doesn't really eat up as much of your remaining profit. I mean, you don't want to pay more, or you don't want to pay enough for the 448s, where it's going to actually take the trade from a net potential profit, even though we go from $350 potential in the tail down to 200. But if you do this earlier on, and let's say you're not paying 15 cents, but you're paying 16 cents or 60 cents, right, and you have 10 of these, so you're spending $600 from 350, $600, that will put you in a negative number, which means that you have a net debit in the tail. And what that means is that if you overpay for these 448s, if the market doesn't sell off, you're going to lose money. Right here, I'm going to make less, but I have this nice protection. But if you pay more than what you have available, and what we have available is 350 right now, if I pay 150, okay, so I'm going to make 200 instead of 350. But in exchange for that, I get a nice hedge. But if I pay more than 350 to close these 448s, I not only stand to make no money, I could potentially end up in a losing trade that has a 98% probability of expiring for a loss. Another question is your general rule of thumb for a stop loss usually 300%? No, I mean, this is slightly different topic, but the idea is, we can go back here, and if my trap, my potential reward in the trap is, let's call it $7,500. If I'm down $7,500, I'm out. Right. So and this is going back to December 12th. So on December 12th, I would take this trade and I would say, all right, if the market goes up, I'll make 510. If the market goes down, but takes a long time for it to go down, maybe I'll catch the price somewhere in the trap. But if the market goes down every single day from the point where I took this trade, and at any given time, if I'm down $7,500, there's no more adjustments, there's no more thinking. It's time to turn off the lights and move on. Um, Another question: when circuit breaker hits, what about slapping on ES shorts with a stop loss at 50 point? Yeah, I mean, yes, sure, that is a good idea, but you have to kind of plan for it, right? Like you have to know in the back of your mind, and everybody's plan is different, right? Somebody just wants to keep it simple and say, look, if I hit my X, I'm out. I don't want to deal with it. I don't want to, because once the market goes down 7-10%, right? Volatility goes, maybe from 18 or whatever it may be right prior to that to like 50. You take a bunch of short ES contracts and the market decides to turn on a dime and go, you know, two standard deviations in your face. What are you going to do with those short ES contracts? So you have to have a plan inside of a plan. It just becomes very complicated. If you've been doing this for a long time, yes, you could definitely delta hedge your positions, right? Because here, let's say, um, if I took this trade, let me just clean up. If I took this trade and let's say the same day, right, we go to 440, which is like 200 points or 5%, right? So we're here and I'm down maybe, $1,300 and my delta is plus 123, right? Could I do something to, you know, prevent myself from sliding down the slope if the market continues lower? Yes. Right. You can short ES. You just need to know your beta weighted position to ES or whatever you're using. Maybe it's SPY. You probably want to use SPY instead of ES. Right. Because buying or shorting shares of SPY has no Greeks, has no theta, it has no volatility. So you get the purest delta you can find, right? So maybe this position is long 123 shares of SPY. You say, you know what, I'm going to short maybe 70 shares of SPY against it, and combined position is going to just level off your T plus zero line a little bit, which means that if the market continues lower, you're not going to take a bunch of heat, and that kind of will buy you the time you need to see if the market is going to continue lower, which is not a problem, or if it's going to reverse and go higher, which is also going to work in your favor. Circuit breakers don't work in a true black swan. Yeah, you're right. I mean, if the market is going to go down 30 to 50%, like overnight, you probably have more problems than managing your 112s. All right, let's. I have one more slide. I want to. This is something that I kind of looked around and tried to figure out. Maybe what would I do instead of closing out? And it's not because it's better, or it's a different adjustment. This is probably something more along the lines of my trading style. Um, so again, in these two scenarios, these two, right? We are spending $15 per contract, right? $15 here and $15 here. So we're going to spend about $150 to make these adjustments, whether it's just closing out the short legs of the put debit spread or buying puts that are further out of the money. We are going to spend $150 of the $350 that is available to us, right? Everybody see that? So what if we were to spend this $150 just differently? And I think I might have messed this up. Um, this is, hang on 1 second. This is, instead of buying to open 10, we were buy to open 1, and we're just going to buy one put that is trading for $1.50 or something close to it, right? Maybe it's a 498. So here, instead of 445, 498 put that is currently going for 498 is going for $1.36. So we're spending a $136, right? This is going to take our 350 tail minus 136. So now our tail profit goes to 214. All right, we're still going to spend some money here and reduce our potential tail profit. And this is how it's going to change the risk graph. You can look at the two other suggestions. All right, let me just clean all of this and this. Why can't I just do this? Oh, there you go. All right. So um, I left these two marks here just to kind of show you guys what the proposed P&L would look like, right? So just closing out the long options of the put debit spread. Let's look at 450. Our P&L is $12,277. Buying options further out of the money at 450 strike, our profit is 11,000, so it's slightly lower. And again, this is one of the reasons why I would prefer to just close out the short leg, right? Higher P&L at 450 versus slightly lower P&L. It's nothing to make it or break it. It's still a very profitable trade, but as we can see, just closing out the naked or closing out the short leg of the put debit spread is going to yield a slightly higher profit. And now buying an option that's way closer to at the money than the put debit spread, right? At the same 450 level, our profit is not as great, right? Instead of 12 or 11,000, we're only up about 7,700. So lower potential reward on a big swoosh lower. But, and here is the but, right? In either one of these two scenarios, and as someone who was it that pointed out potential liquidity risks, if we get a move down, say 11 or 12%, and we're here, this is great, up 11 grand, let's do it. But if your bid ask spread for these options are, 10 points wide, you can't get out, right? Can't get out. So that's, even though your P&L is looking really, really nice, but you can't get out, that's a problem. Here, you still have the potential for liquidity risk because now if you're buying the 498 and the underlying is at 450, these are way in the money, and demand and supply for in the money options isn't as great, so you may be dealing with some potential um, liquidity risks. But here's what I really like about this potential scenario for something like this. If we're here, right? And if the market just stops going up and down, which is very unlikely, when the market goes down 10%, odds are we're going to swing at least 150 points up and 150 points down on the S&P, right? Because volatility is going to be way over 20, or the VIX is going to be way over 20. We're going to move at least 1.5%, maybe more each day, up or down. We don't know which way, right? So if the market stops going down, right? Look at the theta here. You're going to get hammered, right? If 2, 3 days, we only have 15 days, so we don't have a whole lot of time here. We need to move quick. We need to do something quick. If the market just kind of stops going up or down, or if volatility gets hit, right? We're positive Vega here. If the market stops going crazy and volatility just drops, 5 points, which can happen, this T+0 is going to get smoked, right? It's not going to look like this. It's going to look something like this, right? And the more time goes by, eventually this green T+0 line is going to become this blue line, right? So you have the risk of not being able to capture this unrealized gain, whether it's due to liquidity risks or due to decrease in implied volatility, or both, right? So I wouldn't be as comfortable sitting here knowing, oh, my, Black Swan Hedge is so profitable, it's so great. If you don't do something about it, it's all going to go away really, really fast. But if we look at this position here, right at 450, we're not making as much money. Okay, that's bad. But what's good? What's good about it is that our 498 put is in the money. And since it is in the money, it doesn't have that negative theta component. Look at the net theta for this position at 450. We actually have a positive theta, plus 32. That means we're making money every day that goes by without market going up or down. Whereas here, our theta was minus 313. Here we have a positive theta. What else? We have negative Vega, which means that if the market goes down here and then it kind of stops, again, we're not betting on the market to stop going up or down. What I'm saying is if implied volatility is going to fall, right, we have negative Vega here at 450. That's going to help us, and that's going to push this green T+0 line a little bit closer to this line here at expiration. And if the market stays at 450, it's not going to. Don't bet on it. But if it does, last two things I want to compare here. If the market stays at 450 here, right, at 450, which is like right here, we'll make 6K. Great, right? We'll go from, 11 or 12 down to 6. So we'll lose half the potential profit if the market stays down here. But if we are holding one option that's in the money, and early assignment is not a risk here because these are cash settled at 450 at expiration, we'll make just shy of 10,000. So here we'll make 6 and here we'll make 10. So it all depends. Again, this is the reason why I said you want to find or you want to find an adjustment that works for you, right? If you're betting on further downside, this is probably the best way to do it because here you have negative delta and you have positive gamma, which means on the further way down, your delta is going to continue to increase. Whereas here, if we get here to 450 and then the market continues to sell off, look at my delta. We go from 215 to 217, and then it starts to dive, right? I'm starting to lose my delta on the way down. So this is more of a black swan hedge. Like if you think the market's going to zero, this is great. If you think the market's going to go down and kind of, go back and forth, but it's going to stay somewhere within this range here, it doesn't matter, right? If it's going to go up a little or down more, because again, anything above or anything below, I should say, maybe 455, right? You're going to make a profit. Whereas here with the black swan hedge at 455, if you do nothing and the market stops going down, this hedge is going to become less and less effective and eventually will yield a much smaller profit. I hope I didn't confuse everybody. I hope that I didn't scare anyone with these kind of adjustment ideas, but definitely something for everybody to think about, right? And before you make any adjustments, it's definitely great to have a tool that you can use to, take a look and understand, analyze how different adjustments will affect net Greeks and how new proposed net Greeks will uh, play with a combination of your other positions that you may be holding. So we went on for about an hour. If you guys have any questions, let's take a few more, and I'm going to have you on your way.